In this video, I'll show you the exact strategy that led to everybody who is using it to profits like all of the ones you're seeing on the screen right now. Now, passing profit challenges, no problem. Going on extensive winning streaks that don't seem to stop is also nothing special to us anymore. It's simple, it's systematic, and most importantly, it works, as I'm going to show you the backtesting results by the end of the video. Alright, so before I'm going to show you the entire strategy, we have to understand a couple of different concepts. Now don't worry, I'm not going to show you what an uptrend or downtrend is. This goes a little bit farther than the usual stuff that you hear and also see on YouTube. Now you can already see it, liquidity equals to fuel. What I mean by that? Liquidity is the reason why you are able to trade from home. But where does liquidity reside and how do I identify it? Every single swing high or swing low that you see on the chart has liquidity above or beneath it. Now that also means that every single time that you have taken a trade, you were either right on the liquidity or wrong. But what do I mean by fuel, to be more exact? When you're having a downtrend, such as in this case, because you have lower lows and lower highs, we need to take out the opposite direction of liquidity in order to continue in that direction. Now, as you can see, in this case, we went higher and we have not taken out a swing high. But this is exactly the point that I'm trying to make. Liquidity does not have to be something that you see every single time. There is no such thing that tells you that this specific high has more liquidity than this specific low, for example. This is why we have to pair it with additional confirmation, which I'll also show you now. So FEGs are probably one of the most classic things in order to identify liquidity. Now, but unfortunately, a lot of you guys are just trading them wrong, and that's exactly why you're not seeing any trading success. Now quickly, for the ones that don't know, an FEG is when you have candle number 1, number 2, and number 3, and you have a gap right between candle number 1 and also number 3. That creates a gap, and there's liquidity residing in there. So once again, what most of you guys are doing, you are trading into an FEG and then you identify some kind of other level, which most of the times is actually just a random level. I'm going to explain it further when we're going to go into the backtest. You basically want to trade into that liquidity point. So basically you are using the FEG as support and resistance. But what if I told you that this is not wrong, but it's also far from ideal? Because don't get me wrong, this can work and a lot of the times it will work. The problem is just that, what if price decided to go for this FEG? Why did it stop at exactly this one and trade higher? This is exactly the point that I'm trying to make here. So instead of trying to trade away from the FEGs, you want to trade into them. Because look at it this way. Why should you have to wait for price to return into the FEG in order to then take a trade onto the upside in this case? Wouldn't it be way more efficient if we identify some kind of other liquidity point? So basically that is our fuel point to now trade lower because we have taken out liquidity to the opposite side. So this way we're trading into the FEGs and not away from them, because realistically a lot of the times, or to be exact, more than 90% of every single FEG that you will see on the chart actually gets traded back into. Now, of course, you will always find some kind of FEG that has not been traded into yet. Now, first things first, that doesn't mean that this specific FEG will never get hit in the history of this entire chart. It just takes a little bit longer. Now, of course, this will be way too long for us to participate in the entire trade until that actually happens. This is exactly why context matters so much, and you shouldn't just trade a blind FEG just because you have spotted. Remember what I've told you earlier, in order for the price to go in a certain direction, it needs to take out the opposite direction of liquidity. So if you want the price to go lower, you first need the price to go higher, take out liquidity, and then it has enough fuel to actually go to your profit target. So an actual example of this would be, you have seen that this has been taken out. So from here, you're simply going to take an easy position. Your stop loss can be, let's just say, this high, and this is basically going to work every single time. This is how you're going to actually scalp the markets instead of keep on guessing it. Now, but a very important point is that concepts alone don't make profitable traders. So you also have to understand that the context matters a lot. So in this case, we have relative equal highs. Relative equal highs is when you have two swing highs being relatively equal close to each other. That is even more liquidity that has built up if you have two swing highs that have not taken out each other. Now I want you to keep it super simple in here. Don't look at everything that has happened in here. This is all just useless information at the end of the day. What I really want you to focus on is this high, this low, this high, and also this low. Now, if you're going to connect all of these different swing highs and swing lows, what will you get? You're basically having a market that is not going in any direction. This is where so many traders are messing up. They see all of this different information, which doesn't even matter to begin with. It has no value. Not everything that you see on the chart has actual information for you to build off a trade from. But more importantly, what can we spot if we're just going to zoom in a little bit? You can see that we have an FEG in here. Now, what I told you previously, we like to trade back into the FEGs, and then from there on, we don't really care what the market is going to do. But this is why context plays a big role in everything I'm going to show you in just a bit. Simply because we already have a lot of liquidity in here. So basically you have to weight the liquidity. So in a nutshell, what do we have? We have liquidity to go to the downside, but we also have liquidity to go to the upside. Now your job as a trader is to decide which one of these liquidity points holds more weight. Is it this one or is it this one? Now if you would have said that it's going to be the FEG, then you were wrong. Now of course, there is way more liquidity residing above these highs, simply because the time that they are standing there is just way longer than this freshly created FEG. So logically, you're waiting for price to go higher, and then from there on, you can start trading your regular FEGs such as in here. Now, don't go for extreme FEGs that have just created onto the chart. If you have a higher time frame objective, such as in here with the relative equal highs, then you only want to trade the FEGs that are very nearby to the very recent price action, which is right in here. Right, so here we are at the entire backtesting session. Now, as always, I am going to try to make it as simple as humanly possible, because that's exactly how trading should be. Trading should not be something that is complicated. So firstly, we're on a daily time frame, and I'm going to skip the entire day as the previous day has already moved. So in here, what can we spot? I want to ask myself very simply, are we going for the previous day high or are we going for the previous day low? Now in these cases, if the answer is going to be that you don't know whether we're going for the previous day high or previous day low, then this is not a high probability day to trade to begin with. Now in this case, what else can you see? We have actually taken out liquidity. Now, I'm going to zoom in for you in case you don't see it, but this low has taken out the previous low. So now this is basically a liquidity rate. From here on, that is telling us that we have taken out fuel of the market to now trade to the opposite direction of the market. This is why context matters so much. In previous videos, I've shown you that this exact candle is called a 50-50 candle. A 50-50 candle is when you don't know whether we're going for the high or for the low of that candle. But this is why context matters so much, because we can see that we have an entire FEG which is just on a daily chart alone. So that automatically tells us that the entire bias for the day is going to be bullish. So I'm going to remove the previous day low. From here, we are going to drop down onto the 4-hour time frame and look out for more information that the market is going to give us. Now, can we spot either liquidity and FEG or some kind of other reason for the trade to go higher? Yes, we can. Now, why? Because we have this entire gap which we have not been traded back into yet. Now, in case you are not familiar with gaps, I'm also trading them differently than the usual ICT trader. Now, let's just say that you have some kind of price gap and it's looking something like this, right? The price was not able to displace, the chart was not able to basically trade into that. Now, once again, most of you would just want to use it as an entry, and then from there on, you want to trade lower. Now, once again, that can work, but it's not ideal. I want to trade into the gaps because essentially what a price gap is, that is an entire inefficiency in the market. So it means that the price was not able to generate enough liquidity for you to actually trade that kind of price. And in 99% of the times, price goes back into those kinds of gaps. So now I'm going to drop down onto the 1-hour time frame, and we're going to look out for even more information. So, and as always, guys, we're keeping it extremely simple. What can we spot on the chart alone? So we have liquidity being taken, that's number 1. We have an entire FEG that we also want to trade into, that's number 2. Now on the 1-hour chart, these are also relative equal highs. So this is now number 3. Number 4 is this entire gap that we also want to trade into. Now, and on the 1-hour chart alone, what can you spot? Once again, we've taken out liquidity of the opposite direction of the market because we want to trade higher. So in this case, this is basically light work for us because we want to trade onto the upside, not to the downside, obviously, simply because the framework is screaming to go to the upside, not to the downside. Now, since the win rate of this entire strategy is so high, I am going to risk 3% on every single trade. Don't even try to risk 1% on every single trade because it's simply not worth it. The win rate of this strategy is so high that you're not going to lose 10 times in a row. So as you can see, that is the first trade that we have taken, and it's a win. Now, I am going to remove all of this so we can have a fresh start going on to the next day. From here, I want to basically skip the entire day because this is the trade that we have taken already. Now from here on, this is a classic 50-50 candle. This is what I was referring back to earlier. When you have a candle which has basically large wicks and a very small body to it, then that means that this is a 50-50 candle and you don't want to trade it. So in this case, you're simply not going to take a trade. Simple as that. Don't force trades. Don't also look out for 10 different reasons on why I should still take a trade. Stay disciplined, and that's no trade for us. So I'm going to skip on to the next day. This is also a 50-50 candle. I cannot tell whether we're going for the low or for the high. The only real information that the market is giving us with this entire candle is that it has a big wick onto the downside. So this is telling to me that sellers were not able to displace lower and lower. So this is an indication that buyers are slowly getting into control. Because remember, we are currently in the downtrend. And this is not subjective, this is an actual fact. We are trading lower. But we can't really tell, so we're going to skip the entire day. Now, and this is essentially the same. We have wicks onto the downside and we just can't tell whether we're going for the high or for the low of this entire candle. This is still everything on a daily time frame. Everything right now is still on a daily time frame alone. Most of the times when you're not going to take a trade, you already know it by just looking at the daily time frame. So we're going to skip the entire candle as well. Now in this case, we've already taken out the previous day high, so this is also no trade for us. We're going to skip on to the next candle. That is still no trade, so we're going to skip it. Now in here, things are a little bit different now. This is exactly where you have to pay attention to what I'm telling you here. So although we have a lot of different 50-50 candles, so everything from this point on all the way till this point is all just 50-50 candles and should not be traded completely. However, what makes this current day that we have right now more special than the previous ones? Simple as that, I'm going to break it down for you. Now, first things first, are we going for the previous day high or for the previous day low? The first thing that you can already spot is that we are closer to the previous day high than to the previous day low. Now, granted, this is still a 50-50 candle on its own, but context is also telling us more information. If we're going to mark out this high, then these are essentially relative equal highs. Now, you might be saying, well, but you have said that relative equal highs is only when you have two swing highs being relatively equal close to each other. Yes, but if we're going to go lower onto the time frames, then this will actually be a swing high. So this is the first indication that probably we will go onto the upside and not to the downside. But what else can we see? We have already taken out the opposite direction of market participants right in here. So this entire candle low, so basically the previous day, has already taken out market participants who have set their stop loss below the previous day low of this entire candle. So now we'll drop down onto the 4-hour time frame and remove a couple of different things. Firstly, let me remove the entire previous day low and also the liquidity rate. Now, this is exactly what I've told you previously. If we're going to drop down onto the 4-hour time frame, then we'll see two swing highs being relatively equal close to each other. So in this case, we know that there is more liquidity residing higher than lower. Once again, liquidity has been taken in here. But what else can we spot on the 4-hour time frame alone? We have a gap. Now remember, we have actually traded into the gap, and in this case, it's not going to be a different story. The difference in here is just that we want to trade onto the relative equal highs. Why? Because once again, liquidity has to be weighted, and in this case, the relative equal highs have more weight to trade into compared to the small gap that we have in here. But that doesn't mean that we can't trade into the gap. This is what we're going to go into the 1-hour time frame and look out for more information. Now, if you are going to skip a little bit off the chart, then we can quickly see that we also have relative equal lows. Now, the relative equal lows were before we even go onto the 4-hour time frame in that sense. So they still hold a lot of weight. But what else can you spot alone? There's also an FAG. This is exactly why if you just have a couple of different concepts that I'm showing you here and just trying to take a trade, then that's not going to be enough. There is an entire framework before you're going to enter a trade. I've told you previously, there's a lot more weight going on to the upside and not to the downside. However, this changes a lot of different things. I have purposely not marked it out right from the start, just so you can actually think about it and see, well, but there's also relative equal lows. For anybody that has seen the relative equal lows before I've talked about anything closer in here, then congrats, you're actually pretty advanced into this way of trading. If not, then you still have a lot to learn. So you might be asking, what holds more weight? Is it going to be the relative equal highs or the relative equal lows? It's going to be the relative equal lows because there is an FEG. I've told it a lot of different times. An FEG plus relative equal, for that matter, X, is way more efficient than anything you will ever see on a chart. So in this case, taking a short onto the downside will be more favorable than taking a long. However, neither of those is the correct answer, because once again, if we're going to go onto the daily time frame, our bias is still bullish, remember. So onto the 1-hour time frame again, if you have reasons to go lower but also to go higher, then you should just not take a trade at all. This backtest is mainly for showing you how to avoid the bad trading days. In one of these directions, we will go for the entire day. Prices just won't magically just stay in this area. However, we still don't want to take a trade, guys. So I've just skipped the entire day. We're still on the 1 hour time frame, and we have basically gone for this entire low. Although the entire bias was to go to the upside. This is why you have to avoid these kinds of days. Now from here, I'm going to speed up the pace a little bit faster. Now in this case, we have already taken out the previous day low, so this is no trading day for us. Now in here, once again, are we going for the previous day high or for the previous day low? By definition, yes, if you have said that this is a 50-50 candle, you are correct. But the difference in here once again is, and I already see this as a potential trade entry. Why? Because this is basically the same that we have done in here. Remember this trading day that we have taken? This is also a 50-50 candle. But since we had an FEG in here, we were still ready to take a trade onto the upside. This is exactly what I'm trying to tell you. An FEG is most of the time also a relative equal high or relative equal low. So in this case, we're going to drop down onto the 4 hour time frame and look out for more information as always. Now, can we spot more reasons for the price to go higher? Yes. We have relative equal highs once again. Now, don't just mark out any relative equal highs. No, these are also relative equal highs, but they don't matter that much because you have to take the extreme levels. So basically, all of these highs and all of these lows. In this case, we don't even have relative equal lows onto the time frame, so this is an A+ setup basically. Why? Because we have an FEG also in here. So we not only have an FEG on a daily time frame, but also on the 4 hour time frame. Now I'd like to look even for more reasons to trade onto the upside. Now on the 1 hour time frame, I'm mainly not looking for confirmation anymore. I'm mainly looking out for some kind of reason that is speaking against a trade. Now yes, there's even more engineered liquidity in here because this is just not efficient price action because we're basically trading lower without taking the opposite direction and then trading lower again. This has not happened here. We're just trading lower and lower. This is why we need to take out liquidity to go to the upside. So from here on, we're basically just going to start our regular session time, which is going to be 0 AM, and it's going to be the next candle open, and you want to trade onto the upside. So our profit target is basically going to be these additional relative equal highs, so basically this engineered liquidity, and our stop loss is going to reside right at the previous day low. Now usually what you would like to do going into the 4 hour time frame is look out for some kind of other logical level that you could put your stop loss below. Now in this case, there is not really some kind of level that we want to trade into. So we're just going to keep it very simple and put our stop loss right at the previous day low. From here, we want to risk 3%. In this case, I don't see any kind of entry refinement, such as going for some kind of relative equal lows. There is nothing that we could really base it off from. Additionally, we have also already traded into this FEG, and if we're going to put our stop loss in here, then this is basically not giving enough room for the entire trade to breathe. So on this one, we're just going to keep it very simple and see what the outcome of this entire trade is going to be. Now, we want to endure any kind of drawdown that we're going to get into. Don't try to basically bend the strategy or look out for some kind of other reason to basically not take the trade, move your stop loss, or any of that kind of stuff. Stick to the buys and stick to the analysis, because this is essentially the only thing that will prevent you from taking massive losses. Now, it does take practice to trade like me, but the rewards are so worth it that I can guarantee you, you will see great success if you're going to trade exactly like me. Now guys, this is a very big misunderstanding that I've seen a lot of different traders are making. They be saying with a negative risk reward, I need to take a lot of different trades in order to make a lot of profit. We have only taken 3 trades across 13 days of just pure price action, and we have made more than $2,200. Now, of course, if we would have traded this in the live markets, it's because with this of a high win rate, you're not going to lose 10 times in a row. But even if this is too slow for you and you are having problems passing your profit challenge, then I will pass it for you. In case I don't pass it, you'll not only get the money back that you have paid me, but you'll also get the money back that you have paid the prop firm in order to get the challenge. If that sounds good to you, everything is in the description down below. Now, but more importantly, if you want to have the same results that I did in this backtesting session, and matter of fact, this is not just cherry pick setups, and certainly this is also not just done in a backtest. Now, I don't want to be annoying, but I mean the results speak for themselves. My students have been killing it on a day-to-day basis. Now, and keep in mind, this is far from everything that we have been doing in the entire mentorship, because we're just simply not showing everything that has been going around in the mentorship. We have guys passing prop firm challenges on end, and more importantly, just overall a lot of different people who have making a lot of money. Such as this guy, he has withdrawn almost $800 by just following the exact signals than I'm giving him. If that sounds good to you, it's all in the description down below. Whether you want to work with me or not, I still want you to become a profitable trader. If you want more free stuff, then you can click on this side of the screen, because this is going to explain to you further how the strategy works for free. You don't have to pay anything, as this is simply just a YouTube video. If you still haven't liked the video up until this point, then make sure to leave a like, subscribe to the channel, and comment down below what your favorite setup of this entire backtesting session was. Thank you guys for watching. See you in the next one.